Welcome to Simply Explained Academy. Today, we're diving into a topic that's super hot in the crypto world right now, stablecoins. If you're new to crypto or just curious about how it all works, don't worry, I've got you covered. Get ready to uncover the secrets of these steady digital currencies, explore the different types that could change how you think about money, and learn how to use them safely in 2025. Plus, we'll reveal the risks and future trends you won't want to miss. So, grab a snack, get comfy, and let's get started. First off, what are stablecoins? Imagine you love the excitement of crypto, but you're tired of the wild price swings, like Bitcoin jumping up one day and crashing the next. Stablecoins are like the chill cousins of crypto. They're digital currencies designed to keep their value steady, usually pegged to something stable like the US dollar, gold, or even another currency. That means one stablecoin is supposed to equal $1, or whatever it's tied to. Pretty cool, right? Now, you might be wondering, why do we even need stablecoins? Well, crypto is amazing, but its volatility can be a headache. If you're using Bitcoin to buy a coffee and its price drops 10% while you're sipping, that's a bummer. Stablecoins solve that by giving you a digital currency you can use without worrying about huge price changes. They're perfect for everyday transactions, saving money, or even trading without the roller coaster ride. Plus, they bridge the gap between the traditional financial world and crypto, which is a big deal in 2025. Let's talk about how stablecoins work. The magic happens with that peg I mentioned. Most stablecoins are backed by real-world assets. For example, take Tether or USDT, one of the biggest names out there. It's supposed to be backed one-to-one by US dollars held in a bank. So, for every USDT you see, there's supposed to be a dollar sitting somewhere backing it up. Other stablecoins like USDC from Circle work the same way, pegged to the dollar and backed by reserves. This setup keeps their value steady, or at least that's the goal. But not all stablecoins rely on cash in a vault. Some use a different trick, like algorithmic stablecoins. These guys, like Terra USD before it crashed, try to maintain their peg using smart contracts and supply adjustments. If the price drops, the system might burn some coins or mint new ones to balance things out. We'll dive into why that can go wrong a bit later, but for now, just know there are a few ways to skin this cat. So, why should you care about stablecoins in 2025? Well, they're everywhere. Businesses are using them to pay suppliers across borders without the hassle of bank fees or delays. Traders love them because they can park their money in a stablecoin during a market dip and jump back into action when prices recover. And with inflation still a concern globally, people are looking at stablecoins as a way to hold value without betting on volatile coins. As of mid-2025, the stablecoin market is booming, with billions of dollars locked in these assets. Pretty mind-blowing. Let's break down the main types of stablecoins so you're not lost in the conversation. First, we've got fiat collateralized stablecoins like USDT and USDC. These are the most common, backed by actual money or cash equivalents. Then there are commodity-backed stablecoins like Pax Gold, which are tied to the price of gold. If gold goes up, so does the stablecoin. Lastly, we have algorithmic stablecoins, which don't rely on physical assets, but use algorithms to control supply. Each type has its pros and cons, and we'll explore those next. Starting with fiat collateralized stablecoins, the big perk is stability. Since they're backed by dollars or euros, you can trust they'll hold their value. The downside? You're relying on the company behind them to actually have those reserves. In 2021, Tether got heat for not being fully transparent about its backing, and even in 2025, regulators are still keeping a close eye. But these stablecoins dominate the market because they're simple and widely accepted. Now, commodity-backed stablecoins are a bit different. If you're into gold or silver, this might appeal to you. Pax Gold, for instance, lets you own a piece of gold digitally, and you can even redeem it for the real stuff if you want. The upside is you're tied to a tangible asset that's been valuable for centuries. The catch? The price of gold can still fluctuate, and storage or redemption costs might eat into your profits. Still, they're growing in popularity in 2025 as people seek alternatives to fiat. Then we have algorithmic stablecoins. These are the wild cards. They try to keep their peg without holding assets, using math and code instead. The idea is cool. Adjust the supply to match demand. But here's where it gets tricky. Back in 2022, Terra USD and its sister coin Luna collapsed spectacularly, losing billions because the algorithm couldn't handle a market panic. As of 2025, new algorithmic projects are popping up, but they're still risky and not as trusted yet. Speaking of trust, let's talk about the risks. Stablecoins sound safe, but they're not bulletproof. One big worry is if the backing isn't legit. If a company like Tether or USDC gets caught with less money than they claim, the stablecoin could crash. Regulators in the US and Europe are cracking down in 2025, pushing for audits and transparency. That's a good thing for safety, but it could shake things up if big players fail the test. Another risk is centralization. Most stablecoins are controlled by a single company. If that company gets hacked or goes bankrupt, your stablecoins could be in trouble. Compare that to Bitcoin, which is decentralized across thousands of nodes. It's a trade-off, stability for less control. And don't forget market risks, like if everyone rushes to cash out at once, the peg could break, especially with algorithmic types. So how do you pick a stablecoin in 2025? First, check who's behind it. Look for companies with solid reputations and regular audits. USDC is a good example here. Next, think about what you need it for. If you're trading, a fiat-backed one like USDT might work best. If you want a gold hedge, try Pax Gold. And if you're feeling adventurous, an algorithmic one might tempt you. But proceed with caution. Always do your homework and start small. Let's look at some real-world uses in 2025. Stablecoins are powering DeFi, where you can lend, borrow, or earn interest without banks. Platforms like Aave and Compound let you use stablecoins to grow your money. And as of mid-2025, that's a hot trend. They're also big in cross-border payments. Companies like PayPal are testing stablecoin transfers to cut costs. Even some countries are exploring central bank digital currencies, which are like government-backed stablecoins. The future's looking bright. Now, what's the catch? Regulation is tightening. In 2025, the US Senate just passed the Genius Act, which requires stablecoin reserves to be fully backed and regularly audited. Europe's got similar rules under MiCA, the Markets in Crypto Assets regulation. This could make stablecoins safer, but might limit innovation or push some projects out of business. One fun fact, as of the making of this video, the total market cap of stablecoins is over $255 billion, with USDT and USDC leading the pack. That shows how much trust people have in them, despite the risks. And with crypto adoption growing, over 850 million users worldwide now, stablecoins are only going to get bigger. So, should you jump in? If you're a beginner, start by learning more. Use a trusted exchange like Coinbase to buy a small amount of USDC or USDT. Store it in a secure wallet. Hardware ones like Ledger are great for safety. And never invest more than you can afford to lose. The crypto space is exciting, but it's not a get-rich-quick scheme. What do you think about stablecoins? Are you using them already, or are you still on the fence? Drop your thoughts in the comments. I'd love to hear from you. If you enjoyed this video, please hit that like button, subscribe, and ring the bell so you don't miss our next dive into crypto.